If you're invested in a fund that follows the S&P 500, about 40% of your money is effectively tied to the performance of just 10 companies, most of which are deeply invested in AI development.
The S&P 500 is an index that is made up of publicly traded stocks of the 500 largest companies in the United States. And each one is given a weighting based off the market size of that company.
The S&P 500 is up more than 40% since October 2021, thanks largely to AI momentum. Nvidia especially has seen massive gains in the past couple of years. It rose more than 230% in 2023 and 170% in 2024. It's now more than 7% of the S&P 500. That means that one company now carries as much sway in the S&P as the bottom 224 stocks combined.
For many people, and I would say most investors in target date funds, a significant portion of your portfolio, particularly equity, is in the S&P 500.
Well, I think investors have gotten so used to the idea that the S&P 500 is a relatively low-risk way to invest, and it's kind of obscured the fact that it's a technology mega-cap fund today.
Others feel this bias toward tech and AI is an opportunity for investors to get ahead.
I think tech continues to lead the market higher, and that ultimately has really changed the game for investors.
So what does this concentration mean for the millions of Americans whose financial futures depend on the S&P 500? The S&P 500 is what's called a market cap weighted index. That means bigger companies have a bigger influence on how the index moves. Investors measure market capitalization by taking the number of shares a company has issued and multiplying it by its stock price. Therefore, if investors are driving up a stock's price, that can increase the company's market cap, which will then increase the company's weight in the S&P 500. That's one of the reasons why the S&P 500 has become so heavily driven by AI and tech giants.
Nearly half of the S&P market cap has medium to high exposure to AI, according to Citigroup's estimates. So what that means is that a lot of these companies in the index have put big bets on the emerging technology that's set to come out. The question is, will those bets pay off?
People are really optimistic about these companies, which is driving up the stock price, which is going to continuously increase the market capitalization, which will increase the market weight or the weighting in the S&P 500.
But because of the surge in AI enthusiasm, the S&P 500's performance now increasingly tracks a few very large tech stocks. The median stock in the index has risen less than the top-performing tech stocks.
Over the last few years, the vast majority of the earnings and revenue growth that we've seen in the S&P 500 have come from tech and AI more specifically.
To some investors, that kind of concentration looks risky, but others see it as a sign of strength.
I think it's a great thing because right now the biggest asset in this U.S., when you think about across the country, it's Silicon Valley. It's AI, it's the arms race, that we're ahead of China. That's why you're seeing, even on S&P, the additions continue to be new tech, next gen versus maybe old legacy. And that's a positive as this continues to play out.
The idea behind the S&P 500 was to give investors a broad look at a much more diverse set of stocks to follow an index that way, whereas before you had the Dow Jones, which was just 30 names, obviously much more concentrated, a much smaller slice of the public markets.
So you've seen luminary investors like Warren Buffett of Berkshire Hathaway or John Bogle of Vanguard have touted the strategy of investing in the S&P 500 fund exclusively. If you set it and forget it and just buy and hold the index, you can make money over a long period of time and become rich. There have been ETFs and mutual funds that have started around the S&P 500, and the attraction there is that they mirror the index very closely, and they are low-cost funds that are passively managed so that you're really getting exposure to the big names in the stock market without paying a lot of money.
Investors will often strive for a diverse portfolio to ensure that one stock that has some sort of cataclysmic event that might cause the price to drop by 20, 30, 50% wouldn't have an outsized impact on the value of their portfolio. So having the diversification of the S&P 500, having allocations across 500 separate names, historically would provide for insurance against one name blowing up and having an overly negative impact on your portfolio value.
I think set it and forget it is no longer as applicable if your entire portfolio for retirement is in the S&P 500. Even regardless of what's happening in the AI market, it really isn't well diversified.
The top 5 companies alone in the S&P 500, Nvidia, Microsoft, Apple, Google parent company Alphabet, and Amazon, represent nearly 30% of the index.
And so many people aren't aware how their retirement portfolio performance or taxable account portfolio performance is really dependent upon the success of these 5 companies.
The S&P 500 is still diverse for sure. You still have 500 names that make up the index. It is, however, much more concentrated than it has been throughout most of its history. There's probably some level of truth in calling the S&P 500 just a mega cap tech fund at this point. But when you look at the broader economy now, so much of that is tech and tech related. It's becoming something that is all encompassing. So having an index that is representative of our economy being so weighted toward tech and AI, you could actually argue makes a lot of sense.
But some see this concentration as an upside for investors.
You want the average investor to have more exposure to tech rather than less. I'd rather be owning tech in the left lane of Ferrari going 100 miles an hour than going 45 miles an hour in the right lane with value. I just think tech is where the growth is. That's where the asset values are going to continue to go higher. And you want to be more exposed to AI. And I think these indexes have really created that. We're living in a 4th industrial revolution. And I think the market is starting to reflect that. And it's an exciting time to be an investor in U.S. tech. I think big tech's going to continue to lead this market higher. I think it will spread to mid cap and small cap, but I think it continues to be led by big cap tech. The point is this is going to spread to the rest of the market, but it starts and it ends with big tech.
As AI continues to spread across different sectors and reshape the economy, investors may need to reevaluate what it means to diversify their portfolios.
For investors in the S&P 500 index and the markets more generally, it pays to have a diversified strategy. So if you're investing in the S&P 500 index in particular, and you're concentrated in that, you run the risk of having losses that might interfere with your personal timeline, say retirement or another investment goal. And you also may feel the urge to react emotionally if the market is down or even if the market's up. So experts always say to have a diversified strategy. There may be times when the S&P 500 does better, and then there may be times when international stocks, value stocks, small cap stocks do better. And so if you have a diversified strategy with other stocks and bonds, you will have a portfolio that may not rise as dramatically, but it won't fall as dramatically with the market's ups and downs.
Financial experts recommend spreading risk across different company sizes, sectors, and regions of the world. That mix typically depends on an investor's time horizon.
Someone's time horizon to retirement, 10 to 15 years versus 30 years, can be quite significant because that allows the investor who has a longer time horizon to take on more risk in their portfolio because they have much more time to recover if things do not go as they would like. So typically, if you're an individual who is 30 plus years to retirement, we're going to focus primarily in stocks or equities. We're going to focus probably more on a higher international allocation, but with that comes a higher level of volatility and risk. We may have more allocation to tech because it does typically have higher long-term performance versus if someone is 10 to 15 years from retirement, we still will have equities and stocks, but we may do something a little bit more defensive. And by defensive, I mean maybe not all in tech and growth, but maybe having an allocation to more value-based companies, more traditional stock-like equity performance, like a Johnson & Johnson, or more of the consumer staples or utilities, or stocks that provide more dividend income, that offer more stability, but still gives you some long-term growth.
This strategy starts with knowing what you already own.
It's important for investors to understand of the ETFs and mutual funds they have, what is my current exposure to AI? And if I buy stocks out of that, am I comfortable increasing my exposure in that significant of a way? I think people just see sometimes funds or ETFs as like a blended portfolio, not realizing that they could be building more concentration and less diversification on how they purchase individual stocks.
Another way to lower concentration risk is to change how you invest in the S&P 500 itself.
The easiest way to maintain exposure to the S&P 500, but to lessen the overall exposure to tech and AI, would just be to go with an S&P 500 equal weighted index exchange traded fund. The difference there being, instead of each member being weighted by their market cap, each one is weighted the exact same. So you don't get these outsized influences from a handful of large names or one sector that is leading the returns. Being in the equal weight index certainly has its drawbacks when you have a bull market like we're experiencing now, where the largest names are leading. So you will miss some upside there. However, it does give you some level of reduced exposure in the event that the largest names are the ones that crack and go down.